In the fast-paced world of Japanese day trading, one name stands out: Takashi Kotegawa, and he made $153 million through his counter-logic trading strategy. Takashi Kotegawa wasn't your average trader. His trading strategy was based on bear markets. Yep, the markets where everything feels like it's falling apart. Takashi believed that when stocks get hammered down, they often go too far. Think of it like a rubber band that's been stretched too much. Eventually, it snaps back. He wasn't just guessing when to jump in, though. Takashi had a laser-focused approach to spotting when a stock was oversold and ready for a rebound. His specialty? Stocks that were in a long-term downtrend. Sounds risky, but Takashi had a system. He looked for stocks trading well below their 25-day exponential moving average, EMA, like 20% below at a minimum. If it was 35% below, even better. That's where he felt most confident. And let's face it, confidence in trading is half the battle. Think of the EMA as Takashi's guiding light. It was his primary tool for spotting oversold conditions. Why the EMA and not a simple moving average? Because the EMA gives more weight to recent prices, which means it reacts faster to what's happening now. It's a big deal when you're dealing with short-term trades. Takashi zeroed in on stocks trading 20%, 35% below their 25-day EMA. Why this range? A 20% gap was his baseline for identifying stocks that were oversold but still had room for a solid rebound. When the gap widened to 35%, it was like finding gold. These were the setups he loved because they often signaled an even stronger bounce. But Takashi didn't just blindly trust the numbers. He cross-checked the EMA reading with other indicators to make sure the stock wasn't oversold for a reason, like bad news or a fundamental flaw. This way, he filtered out the noise and focused on the stocks that had real potential. If the EMA was the foundation, the RSI was the traffic signal. It told Takashi when it was safe to go ahead. The RSI measures whether a stock is overbought or oversold on a scale of 0 to 100. A reading below 30? That's the sweet spot. It meant the stock was likely oversold and undervalued, which was exactly what Takashi was looking for. But here's the catch. RSI isn't foolproof. Sometimes a stock can stay oversold for longer than you'd expect, especially in bear markets. Take a look at this chart. Notice how the RSI moved below 30 into the oversold zone. If you followed the typical strategy and bought right here, thinking the market was about to reverse, you would have lost money. Why? Because instead of reversing, the price kept falling, and the RSI stayed oversold for a long time. If you want to learn more on how to use the RSI indicator the right way, check out the video I've linked in the description. But now, going back to Takashi Kotegawa, for him, the RSI was a confirmation tool rather than a standalone indicator. If the RSI lined up with the EMA gap he was looking for, it was like getting a thumbs up to move to the next step. The MACD was Takashi's final check. While the EMA and RSI told him if a stock was oversold, the MACD helped confirm if momentum was shifting in his favor. The MACD was Takashi's final check. While the EMA and RSI told him if a stock was oversold, the MACD helped him confirm whether momentum was shifting in his favor. Here's how it worked. Takashi looked at the MACD histogram, which shows the difference between the MACD line and the signal line. When the histogram turned green, it meant bullish momentum was building. Basically, the stock was gearing up for a bounce. Why the MACD? Because it's a momentum indicator, and Takashi knew that timing was everything. A green histogram was his signal that the stock wasn't just oversold, but also ready to reverse direction. Without this confirmation, he risked jumping into a trade too early and watching the stock dip even further. Each of these tools, the EMA, RSI, and MACD, served a specific purpose in Takashi's strategy, but their real power came from how they worked together. The EMA gave him a starting point. The RSI confirmed oversold conditions, and the MACD sealed the deal by showing a momentum shift. For Takashi, trading wasn't about luck or gut feelings. It was about stacking the odds in his favor. And with this trio of indicators, he did just that, trade after trade. Before he even touched a chart, Takashi started with a stock screener. He used platforms like TradingView to filter out the noise and zero in on stocks that met his criteria. His filters were specific: stocks trading at least 20% below their 25-day EMA, no erratic price behavior, and priced above $1 because penny stocks were too unpredictable. He also made sure the stocks were in sectors aligned with the current market sentiment. It wasn't about finding just any stock. It was about finding the right stock. Takashi understood that different sectors required different strategies. Tech and biotech stocks, known for their high volatility, demanded a larger safety margin. He'd only consider them if the stock price was significantly below the EMA. In contrast, stable sectors like utilities were much more predictable. For those, he was comfortable entering with a smaller gap below the EMA, knowing the risks were lower. But it wasn't just about the stock or the sector, it was about the bigger picture. Takashi was all about understanding the vibe of the market. Is the overall market feeling optimistic, bullish, or is everyone fearing the market, bearish? To figure this out, he analyzed major indices like the S&P 500 and ETFs like XLK for tech or XLU for utilities. If the market was bearish, he'd go for stocks with bigger gaps between the price and the EMA. If it was bullish, smaller gaps worked just fine. Why? Because in bear markets, stocks tend to overcorrect, giving more room for a rebound. In bullish markets, the drops aren't as dramatic, so you've got to adjust your expectations. Here's a pro tip from Takashi: keep your charts clean. Many traders clutter their charts with countless indicators and levels, making them almost impossible to read. Not Takashi. He kept it simple, focusing on EMA lines, key support and resistance levels, and one or two indicators like the RSI. These were the essentials that gave him clarity. Okay, so Takashi found a stock that ticked all the boxes. Now what? This is where his precision came into play. He zoomed in on the 15-minute chart to get a closer look at the price action. He wanted to see the stock holding steady at a support level, maybe even starting to bounce. If the gap between the price and the EMA was narrowing, and the RSI and MACD were giving him the green light, he'd make his move. Here's where many traders fall short. They don't plan for what happens after they enter a trade. Takashi was different. He always had a clear strategy. His take-profit levels were set at the next major resistance point, which made perfect sense. And his stop-loss? Strategically placed just below the recent low. Now let's discuss timing. Takashi's approach was all about precision. He didn't hold on to stocks endlessly, hoping they would reach an ideal take-profit level. Instead, he preferred to hold trades for 2 to 6 days. Why? Because the longer a trade stays open, the higher the chances of unexpected market changes. A stock could reverse direction, erasing gains or turning a profit into a loss. To avoid this, Takashi often closed his trades manually within that time frame. He focused on securing profits rather than waiting for a predefined target. For him, managing risk and achieving consistent gains mattered more than chasing perfection. In bearish markets, he aimed for smaller profits, knowing reversals could be weaker. In bullish markets, he allowed trades to run longer to maximize returns. It was all about adapting to the market conditions. Takashi's success wasn't just about charts or indicators, it was about his mindset. He wasn't gambling on hunches or chasing quick wins. His strategy was grounded in principles anyone could follow with focus and discipline. And those principles transformed his trading into a $153 million success story.